Welcome back to the course Introduction to Commercial Banking and Fintech, and in this particular course, in the last session we touched upon some of the tenets of the Basel III norms and how Basel III norms evolved over a period of time, and we discussed the leverage ratio, and we also touched upon an example that gave us the idea that even if the leverage ratio even if the CAR is having the same value, leverage ratio gives you a better regulatory understanding than the CAR, and how Basel I norms of the CAR, which continued till now, it can be supplemented by the leverage ratio for the macro level banking regulation. So leverage ratio, in terms of definitions, we know that it is about the tier 1 capital upon the total exposure. So what we saw that post global financial crisis, we have seen those cases. So now we are going for leverage versus RWA. Suppose bank holds government bonds, so it has the risk weight of 0, 5,000 crore. Here we have the corporate loan which has the exposure of 5,000 crore. So here we have risk weight of 100%, and tier 1 capital is 350 crore, and if I have to calculate the RWA and also the capital adequacy ratio, and if I have to calculate the leverage ratio, then how it looks like. So if I am calculating that, so here we have RWA is how much? So 0% weight, and here we have 100%, so it is 5,000. Tier 1 upon RWA, so here it is 7%, so this is what it implies. Leverage is how much? Leverage is 350 upon 10,000, so it is 3.5% overall. So here what it appears that though in tier 1 RWA the CAR looks higher, 7%, but in terms of leverage its value is 3.5. So low risk weighted assets reduce RWA, so this is what implies, but do not reduce the total exposure, right? And in this case what it implies that this scenario leads to the consideration of leverage as one of the important indicators to look at. So overall what appeared that in the example that we just looked at here, it implies that here we are seeing that the bank is able to have the lower exposure, right, and it is having just the government bond and the corporate loans. They can also go for mortgage and household and others, but here the bank is able to maintain, and as a result it is showing the capital adequacy ratio just 7%, and also the leverage 3.5, right. So this is what it implies. Now here in Basel III there is one more topic that has started getting attention, and it is also seeking importance. So unlike capital adequacy ratio, in the Basel III there is a provision of something called liquidity coverage ratio. What is the liquidity coverage ratio? It basically measures the short term liquidity resilience of the bank. So you can think about, now we are going for a micro level regulation, right. So liquidity coverage ratio is how much? So it is high quality liquid assets, so HQLA, upon the net cash outflows over 30 days. So this is what it implies. So liquidity coverage ratio is basically, it is talking about how much we have the high quality liquid assets and how much we have the net cash outflows over 30 days. So this is basically talking about, because less than 1 year, right. So once we have less than 1 year, so we can talk about short term, but it is like 1 month, so it is like very short term, right. So this is what it implies. What is the key component? So high quality liquid assets, which means that it is the assets which can be easily converted into cash. You can think about having the, what we call it as, so one we have the required reserves, then here we have excess reserves, right. Banks also have something called working capital, right. So they keep the amount, then they will be also putting some amount with the SLR. With CRR they don't have, but with SLR they can do. So which means that they have the cash, which is like working capital, they have the central bank reserves, which could be like excess reserves, and government of India securities. For example, if you deposit rupees 100 with the bank, suppose the CRR plus SLR requirement is, suppose it is 5 plus 15, so 20 rupees bank is keeping. So 100 minus 20, so 80 rupees bank is keeping. Now how much it is left? So now out of 80 rupees, suppose bank lend only 60 rupees. So 80 minus 60, 20 rupees it has, and this is what we say. So 25 plus 15, it is called the required reserves. $20, it is called excess reserves. It is up to the bank to either keep this money, or they can also lend to the RBI and get reverse repo. So here in this case, high quality liquid asset basically implies that you are holding a very short term liquidity ratio, maybe treasury bills, HDLs of short term maturity. So basically you are having security which are of short term maturity and must retain value even during financial stress, which means that it is not going to change the value. And net cash outflow, so 30-day stress horizon. So expected cash flow minus expected inflows under a severe stress scenario, so how it looks like. And it also shows that how much we have the deposit withdrawals. If suppose it happens that there is a news coming that particular bank is facing unprecedented risks, so people are now creating a bank run scenario, so your net cash outflows matters. And this was earlier assumed that bank is having sufficient, but in the Basel III norms it is becoming an important. So what is the purpose of LCR? So it is ensuring the bank can have the liquidity stress, they can bear the liquidity stress, provide sufficient liquidity buffer during financial crisis, reduce probability of bank runs and liquidity driven failure. So this is what it implies. And prevent forced assets, which means that it also go for, like, you don't have to sell at any price because you are under stress. So minimum Basel I is that your LCR should be greater than equal to your 100%. This is what we have. A bank must hold sufficient liquid asset to meet net cash outflows for at least 30 days under severe scenario, right? And we know that if you have higher LCR, like liquidity coverage ratio, then you have better stability. Second important aspect is it also improves your confidence of the depositor as well as investors if they are invested, and the resilience of the banking system, right? So it also deals with that. So overall, what appeared that Basel III requirements are important, and in Basel III requirement now there has been a short term monitoring of their exposure. So now you can link with the NPA scenario. There we discuss SMA 1 account, SMA 0, SMA 1, SMA 2. So now you can see that why central bank has gone into that kind of monitoring, because liquidity coverage ratio has become one of the important indicators to look at, and this is where it is very, very important here. Let's have an example. So suppose an Indian bank has the following indicators, like high quality liquid asset, it has 8,000 crore. Expected cash outflow over 30 days, it is going to be 10,000 crore. Expected cash flow deposit that the bank is going to receive. So this is like, here we have the, you can think about the asset side, maybe it can include 30% or 40% as the withdrawal cash outflow, and here we have the cash inflows like interest income and all, and deposits 3,000 crore. So net cash outflow will be how much? 10,000 minus 3,000 is 7,000. So your liquidity coverage is how much? It is 8,000 crore, which means that HQLA upon the net cash outflow. So HQLA is 8,000 upon net cash outflow. So here the ratio that we are seeing, so LCR is nothing but HQLA upon the net cash outflow. Right, so this is what it implies. This indicates that bank holds sufficient liquid assets related to the expected stress outflow. So this is what it implies. So LCR is nothing but 8,000 upon 7, which means that bank is maintaining. So what we just saw, that as per the Basel norms, the LCR must be equivalent to greater than equal to 100%, and what we are seeing is that bank is able to maintain. So it means that this bank is good and it is able to maintain sufficient exposure with the banking sector. Now, how it is important for the India setup, we have also tried to get into. So LCR in case of India, what it has been found with some of the credible sources, that they maintain around 120 to 150%, which means that RBI through its regulations, it has been able to maintain the short term liquidity of the bank, and it has been implemented since 2019. And from the banking sector side, what it comes out that this particular scenario looks very much favorable, and banks in India are highly cash equipped as compared to cash starved that we see, and it looks like the regulatory system is taking care of this very well. So here we have like for example, majority of the time that we often get into, like for example this particular part, here we have the stable funding ratio that here we have. So here we have the net stable funding ratio. One more important term that I wanted to discuss is about how we can understand. So I think this we discussed when we were discussing the GNPA and NPA scenario. So GNPA and NPA scenario. So this is what it implied. So here we had the net stable funding ratio. It was introduced under Basel III, and it was also about the strengthening. So available, how much we have the available stable funding and how much we have the required stable funding. So based on that it reflects. So what it shows that how long, so what is the funding source of the bank that will make the bank stable over time. It also includes both the regulatory capital, the fractional reserve, you have the long term deposits and also the retail deposits, and basically it tells you that how much you have the stable funding, and that can further improve your requirements. So here under the Basel III, so NSFR, which shows the how much we have the amount stable funding, so it has the greater than equal to 100%. So this is what it employs. So it ensures the long term assets which are funded by the stable liabilities, and it also reduces the excessive reliance on the short term wholesale funding, and it also talks about the overall shock. So name itself suggests that it is about the stable funding, but we will have the example to see that how it has. Now if you see in terms of understanding, so it has link with the global financial crisis. Second thing is that because banks are involved with both long term funding and also the short term, so it also required some kind of understanding that how suitable for the bank is to have the sufficient cash flow so that it remains stable. So it was for example long term loans, if it is suppose 50,000 crore for 5-year maturity, and short term funding that it has, it is for the 40,000 crore 1 month maturity. Now this the cash flow, if the short term funding disappears, right, for example 40,000 crore, then bank may have the trouble because it has gone for the long term loans. So there the amount of exposure or the income received will be different. So cash flow of this will be different as compared to short term funding, and this is where it becomes an important case for the banks to look at, right, and this is what it is. So let's have the calculation. Suppose a bank has available stable funding which is equivalent to 12,000 crore, and required stable funding it is 10,500 crore, right. So in terms of NSFR, if you want to calculate, so it is coming out to be how much. So here you can see that it is coming out to be 114.3, which means that it implies that bank has the sufficient funding. It can easily survive. For example, in this case, if the numerator has been the 8,000 crore, right, and your denominator remains same, then of course it will be less than 100, and then you will have to think about building up more of or maybe you will have to think about considering or going for rebalancing of your long term loans, and then you can go for, or you'll have to go for seeking a short term fund. So this is what here. So bank has sufficient stable funding, long term assets are I would say properly funded, and there is a lower risk of liquidity crisis from this funding. So and this is where it becomes a very important case. Now suppose, as I was just mentioning, that if the available stable funding is suppose 8,000 crore and required stable funding is 12,000 crore, so you can see that your NSFR is going to be just 67%, which means that here what it implies that the bank is considered to be very much unstable as compared to short term funding, and it is highly likely that because of this, if there will be any shock coming, then bank will be under the severe liquidity stress, and it may also be requiring the regulatory intervention to restore the funding stability. So in case of Basel III, we can see that liquidity coverage. So there are three major innovations. First was the leverage, which superseded, or which had the better understanding of risk profile of the bank as compared to CAR. Then came the liquidity coverage ratio, which means that it is helping the bank to monitor at the short term interval level that what is going to happen with the overall the risk scenario. Then the third major indicator that we are noticing that it is the stable funding rate. Now how much the bank is having the available funding and how much it required the stable funding, and this ratio gives the clear idea that whether the bank is solvable or insolvable. So this is where it important. So Reserve Bank of India implemented under Basel III framework. So NFSR as per the minimum standard, it is 100%, and it has been operational since October 2021. And in case of India, because majority of the banking units are under RBI and it is well regulated, so they maintain quite a decent ratio, and they are able to meet the Basel III requirements, and majority of the cases we find that banks are able to have the stable funding. So high share of retail deposits, it is called stable funding, right? Lower reliance on wholesale funding compared to the global banks. So this is what. So retail customers in India are more inclined to have more deposits than the withdrawal, and this is the saving mindset that we have, and because of that it is improving the bank's balance sheet because they have the proper stable funding, and improves structural liquidity resilience. So this is what here we have, and this contributes to relatively stronger stability of the banking system. So this is what it implies in terms of overall structure. Now there was also some kind of debate and discussion on the net stability funding ratio, that how has to be. So the argument that are given in the favor of the NSFR is that it reduces the probability of liquidity crisis that we have for the long term and short term. It improves the long term financial stability, because if you have higher, if a funding issue, then this creates trouble. Then the criticism is that it ignores the funding cost. So maybe the bank is going for interbank borrowing and lending, and if they are paying certain rate of interest, which will be normally higher than the normal required investment, then of course this will be another challenge. It also reduces profitability for more stable funding, and may constrain a long term lending and credit supply. And overall what comes out that NSFR, it is telling the bank that you have to have a proper sustainable banking through maintenance of what will be the NSFR requirement in this, right? So this is what here we are. Now we are going for the last part, and I am just summarizing what we have covered in Basel III. So we know that Basel III was introduced after global financial crisis 2008-9. What has been the major focus has been on the common equity tier 1 capital. The second has been on the capital conversion buffer that we saw with the CAR, they are adding 2.5%. Then there is also a debate on the counter cyclical buffer that maybe we will be touching upon in the next session, and we will be trying to understand the buffer side. Then another major innovation that we saw with the Basel III appear to be mostly on the leverage regulation side, that how leverage played an important role, and we saw that how RWA underestimation by bank can be highlighted by leverage, and leverage gives you a better picture. The third indicator that we saw, it was the liquidity coverage ratio, which ensures the short term liquidity resilience. Then the NSFR, which mentions about the long term funding structure. So this is what it tells, and overall what appears that in terms of improvements that we see, it talks about the improving solvency, it also talks about resilience and overall financial stability. So for the learning, those who are doing for the first time, especially the Basel III setup, let me give you the chart. The first thing is that they are focused on the common equity tier 1 for the waterfall, that how banks can be safeguarded, right. Second, they have gone for improving over CAR versus leverage. So here the focus has also been on the CET1 and the exposure, right. The third has been on the, here we have the LCR, liquidity coverage ratio, and also NSFR. So basically it is telling that banks have to go for liquidity management. We have not touched upon we have not touched upon in terms of your buffers, that will be touching in the next class. But for those of you who are doing for the first time, these banking sector regulations, should always remember these three things. If you are able to understand, then it makes task easier. For those who are appearing for any banking sector exams, focus on leverage example that I have given. Then you should focus on the debate between CAR versus leverage. This is important. Sometime you will be asked in interview. Then the third is about the LCR and NSFR. In the next session also, I will try to add some more examples of the LCR and CAR and how it plays important role in that. And this is what, so overall has been with the, and then with regard to the Indian banking system, we can see that the minimum CAR requirement is higher than the global standard. So even if it is 8%, banks are maintaining high. There has been the full implementation of leverage ratio, LCR and NSFR under Basel III in the banking system. So that has also helped. In most of the cases, it is, these two are greater than 100%. So it is around 120 to 150%. So this is also very good. And it has also strengthened the supervisory monitoring and stress testing. So this is also important. What has been seen is that the banks are also having the sufficient capital buffers, typically 15 to 18%, and there is also improved resilience on the NPA cycle and COVID-19 shock, and this is what it implies here. And overall, if I have to summarize in one line, bank Basel III norms for all of us, it has helped in understanding the banking sector stability. It has helped us in understanding the credibility and also the resilience. So with this, I hope we are able to understand the things, and I will be also sharing with you all some of the practice sets on this, and then you will be able to understand it better. We will have the, if you have any questions regarding this, you can touch up, and we have referred different materials available on the RBI. May not be able to cite everything, but we also had to refer some of the news sources. We also referred for this particular session, especially on Basel III, some of the notes available on different web pages, and we had to calibrate with those notes and finally come out with this. So in Basel 3, I hope this structure has given you sufficient idea about. I am free to receive your feedback on this and would be happy to add, and let me know if you have any comments and suggestions. With this, I hope you are enjoying the course. With this, I am stopping it here. Thank you so much, and I appreciate your attention.